The 2017 interpretations of accounts. This is the final viewpoint. We've previously looked at ordinary shareholders. We have looked at basically people willing to invest in shares. Looked at debenture holders who've already given us loans, that have already given us loans, and now we are looking at bank managers. So the bank manager, there's three of them that have previously come up. The one we're looking at here is JB PLC. We've previously covered part A for this before. So JB PLC is a health food manufacturer, and we see at the bottom here that we are to advise the bank manager of a loan of 300,000, of which 6% applied to that would be interest, should be granted to JB PLC. So we're advising the bank manager whether a 300,000 euro loan should be given to them. Straight away we're kind of thinking of, are they capable of paying back a 300,000 euro loan? How will this affect their gearing? How will the extra interest affect their liquidity? Do they have enough profit to pay the interest? There's 300,000 euro, there's 6% interest, so that's 18,000 euro interest that they'll have as well. So are we capable of paying such a high return on interest? A couple of other things as well that you'd look at would be security, as we've looked at for debentures. And then the last one you look at is the purpose of the loan. So there is a seventh thing here. I actually should go through that here first. Liquidity, profitability, gearing, sector, dividend cover. We've seen these in all four. The first two, to do with the ordinary shareholders, had control and share price, which is to do with the market share price, and for this case, if you're getting a new investor, how much control they'd have and their share price as well. The debentures, the share price was pushed out, and what we had instead was we had the security. Security for existing loans, that's the one that we looked at, instead of the share price. And in this one again, we have security, but we also have purpose of loan. So purpose of loan, security, and then we have the original 5 here as well that we need to look at. So 2017. The purpose of the loan is to finance the modernization of their manufacturing plant. Modernization basically means, as you imagine, it's basically to kind of renovate their manufacturing plant. If you think of an old industrial factory, if someone was to put a couple 100,000 into that factory to modernize it, to basically renovate it, put in new machines, things like this, the same way it could be done in a school. If you think of room 4 where we have our classes on Friday evenings, obviously it's an old part of the school. If you were to invest 20,000 into that to modernize it, you'd be improving the IT or improving the general appearance of the room. Modernizing would be kind of, as you'd imagine, to renovate something. The bank loan application. So this is part B. It's for a bank loan. Our fourth viewpoint. Profitability. Again, they're profitable. Gone from 12% last year to 14.79%, which is very high, which is great. It's more or less going to tell us our story straight away about how this company is going to do. It's well above the return from risk-free investment of 1 to 2%, and the company's present cost of borrowing of 8%. The company has a present cost of borrowing of 8% because they currently have debentures of 8% interest, which, as I said, is highlighted here. But we have to apply this to this question too, into banking. To the bank manager's perspective, they're going to have a 6% interest from a loan, so it is well above the 6% interest being charged on the loan. This is a very positive trend, showing that JB PLC are well capable of paying the interest rate. Potentially, though, there could be that 8% debenture and the 6% loan, which would now be 14%, which is very high. But we don't know when this debenture thing is finished. So we can't really comment on it. The liquidity, point 0.8 last year, 0.8 is to 1 last year, 1.11 is this year, which basically means they kind of liquid assets in enough supply to pay back their short-term debts, which is obviously positive. The loan is granted, the company should be able to pay the interest of 18,000 that they will have to pay each year. So they'll have an additional 18,000 euro. If you look at their liabilities here, they have current assets including debtors of 130,000. We are not given closing stock. We could work that out up here. We could probably work out closing stock. I don't know what it is. Off the top of my head, closing stock here is 40,000. So 130,000 minus the 40,000 is 90,000. My trade creditors here is 81,000. So potentially next year they could be in a little bit of trouble. The 81,000 plus 18,000 for interest. But we can't speculate too much on that because that is next year. But as of right now, the trend is good because they have a liquidity of 1.11. So obviously at the moment they are capable of paying their short-term debts. So gearing. So this is one thing actually that you need to kind of think about a little bit. You are letting this company have a 300,000 euro loan. And gearing is basically how much of the company is owned by equity, which would be our ordinary shares and our profit and loss, our profit. So 450,000 and 79,000, so 529,000 is owned basically through equity, and 350,000, this 150 and this 200 is owned or is kind of has been financed in the company in terms of having a loan. Or money kind of that's given to us that we have to pay back. So at the moment we're lowly geared, but there's going to be an additional 300,000 euro loan that's going to go in here for creditors falling due after 1 year. So that will swing it. The company is lowly geared. The gearing position has improved from 45% last year to 39.82% this year. The debt to equity ratio has improved from 45% to 66.16. We're not going to comment on too much there because the big part of this is the fact that there's going to be a major increase in our loan. So if the 300,000 euro loan is granted, the gearing will worsen. More of the company's worth will be financed by basically by money that we owe back by debt. So if the 300,000 euro loan is granted, you'd basically add the 300,000 here to your debt. 200 plus 300 plus 150 is going to be 650 that they'll have in debt versus the, as I said, 529 that they'll have in equity. So their gearing is going to be above 50%. The gearing will worsen to 55.13%, and for the debt to equity ratio it's over 122%. So the company will actually go into a highly geared position. So the business will become highly geared. The business will be financed on a long-term basis, more by debt than equity, which obviously isn't great. The interest cover has improved from 6 times to 8.1 times, which is basically they're very, very capable of paying back interest. And that's good because they'll need to have a high interest cover because next year they're going to have an additional 18,000 euro interest. Why 18,000? Because the loan is 300,000 and there's 6% interest, so that's 18,000. So they're going to need to basically have that high interest rate cover. Security. Security is important because you can't give somebody, like a bank is never going to give out a loan, especially a high loan like this, to a company or to an individual unless there's security, unless there's something the bank can get back if the loan has been failed to be repaid. Otherwise people could claim bankruptcy and nothing would happen to them. The total value of fixed assets is 830,000. We see that here. That's our total fixed assets. 580,000 of which is tangible, most likely buildings, equipment, things like that. So the lender should question the depreciation policy of the company to ascertain the real value of fixed assets. We always really state that because they never really tell us in the bottom, how much the depreciation is charged at and how accurate this amount is. So you kind of always just throw that in. The investments cost 100,000 but now have a market value of 120,000, which is positive. Um, there's already 200,000 of the fixed assets committed to securing the existing debenture. Again, I have this in red. It's relevant to the bank loan and what we're talking about here. We need to look at this from a security perspective. So they have 830,000 worth of fixed assets. And if a company is getting a loan, the bank will generally turn to the fixed assets and say, okay, I'm going to need some security here. I'm going to need to have your building of 400,000. That's going to need to be my security. So if you fail to pay back the loan, I'm going to take over that building. If you look at the debentures in the bottom, they tell us that the debentures have been secured the 200,000 euro debentures have been secured, and that's going to be through our tangible fixed assets. So already 200,000 out of our fixed assets, out of our 580,000, which is tangible. Intangible doesn't really mean much to a bank because the bank can't take over our brand identity, they can't take over our goodwill. So it's mainly tangible that we look at, our potentially investments, but preferably tangible fixed assets, cars, equipment, machinery, buildings. 200,000 of this has already been used for security for this debenture, so they'll want an additional 300,000 because that's what the loan is going to cost. They'll want an additional 300,000 that they can say, okay, this is security, so if you fail to pay back the loan, we're going to take over this fixed asset. So there's already 200,000 committed, but the 580,000 still leaves us with 380,000 after this 200,000, which has been secured previously for that debenture. We have an additional 300,000 here that we can secure for the new loan. So the security for the new loan is adequate. There is enough tangible fixed assets here that are already not secured to a different loan, that we can now turn and say to the bank and say, look, okay, this is our security. There's 300,000 here worth of buildings, and if we fail to pay you back, you can take this building. Dividend policy, again, this is more prominent in the ordinary shareholder viewpoints and not in debentures or banks. So you're only going to comment on dividend cover. The dividend cover has improved from 2.25 in last year to 2.51, which is good. Again, the bank doesn't really care about shareholders getting dividends. From the bank perspective, they don't really want the dividends to go, so they want this to be as high as possible. So this indicates that significant profits are being retained while shareholders are receiving a reasonable dividend. So retention of profits will ensure the new loan is easily repaid. The fact that they're keeping a good bit of their profits, because their dividend cover is high, means that they are more capable of paying back the loan because they have more profits to kind of give back to the business. Almost there. Sector for this one, it's a health food manufacturer. I've gone with because you have to be able to, it can't just be COVID for all of these. We do need to talk a little bit about the industry, but the industry for this generally is quite positive, especially in the last 10 years. There's currently a growth industry for the health manufacturing. The people are more health conscious and are more careful about what they eat. Many people take a variety of supplements as part of their diet. So that's basically just saying, obviously, this is a growing industry compared to 30 years ago. These health food manufacturers weren't as popular. Future prospects are good as this industry continues to grow with awareness. More people are becoming aware of eating healthy, and obviously this is helping health food manufacturers make more money. There are a few notes of caution as the current recession has left people with less disposable income to spend on health food. So by the time you sit your exam, the world will no doubt be in some form of a recession. And basically the fact that people probably have less income means they're probably going to spend less money on disposable spending, such as kind of, I suppose, expensive health food goods. The purpose of the loan, is something that we have here specifically for the bank Viewpoint. Very short, but obviously worth your while to put in. So the purpose we're told here is the loan is to finance the modernization of the manufacturing plant. So renovate the manufacturing plant. The loan is required for the modernization of the manufacturing facility. This is specific and is for productive purposes, so which will help to reduce the unit cost of production and make the company more competitive. Um, the fact that it's specific to the business because they are a food manufacturer is positive. They're spending money on the plant itself. This will probably lead to improvements in efficiency down the line. Maybe they'll have a better quality of good, or their unit cost of production might be reduced eventually because they might be using better quality machines, and this may, I suppose it may speed up the process, and they'll end up spending less on labor and so forth. That's just a quick way of explaining it. But the fact that they've already told us this loan is to do with the business and it's not something irrelevant is quite positive. So it's specific, it's for productive purpose, and it'll help to achieve these things and make the company more competitive. So the extra production will generate more income to repay and service the loan. So this is something that will probably improve the profitability of the company. So that again would be positive for a bank to hear. Conclusion: yes, the manager should grant the loan. Their profitability is quite good at the moment. They're lowly geared. Yes, they'll go a little bit more highly geared, but that's to be expected. Their liquidity has been good recently, so they're capable of paying off any debts they have at the moment. The sector is quite promising, and obviously the loan is for a good purpose. So yeah, they should be quite capable of paying this back. So that's the fourth viewpoint. It's the bank manager.